Welcome back. Personal loans defaults in 2020 managed to ride through the disruptions that were caused in the corporate sector that saw increased layoffs, paid cuts, and unpaid leave policies that saw many Kenyan firms adopt. Now, Central Bank of Kenya CPK data now indicates that non-performing loans among households only accounted for 1.9 billion, which translated to 2.83% of the 667 billion shillings loans that were not repaid in the 9 months through to December 2020. Now, the data further shows that households' loan defaults jumped 19.05% to 67.6 billion in March 2020 compared with 3 months earlier, and then it continued to record single digits in subsequent quarters, even as the country went into further COVID-19 containment measures. Now, the CPK credit management data suggests that bad loans among its households rose 3.11% to 69.6 billion in the quarter ended June, 5.6% to 73.5 billion shillings in the 1 through to September, before falling 5.58% to 69.4 billion in December 2020. Fine. Josh, how do we interpret this data from the Central Bank of Kenya to the performance of the economy? Are we saying things were not really that bad if indeed people were paying their loans?
I don't think we could make that conclusion.
Yes.
I think the repayment of the loans is due to a multiplicity of factors. So number one, when you look at how banks lend personal loans, it's normally on the strength of a payslip.
Yes.
Now, even before COVID, we already had a situation where the economy was quite depressed. So perhaps banks were lending more personal loans to people to what you'd call a more secure client. And by more secure client, I mean, for example, people who work in the public sector.
Yes.
And the impact of COVID has not seen job losses in the public sector as yet. So because again, also banks had the opportunity to lend to government at much higher rates than before. So perhaps they were more careful about who they were lending to when it came to personal loans.
Yes.
The second thing is that typically when people lose jobs, they don't immediately lose their ability to pay loans. It's when they stay out of a job for much longer that you begin to see that impact. So you find that for most people, when they lose a job, for example, they still have 3 to 6 months perhaps before their liquidity issues really crystallize.
Yes.
And before they are at a position that they are unable to pay loans. Finally, I'd like to also mention that perhaps you find that the more risky borrower was borrowing outside of the banking system.
I see.
So you have all these fintech apps like Tala, Branch, and so on and so forth, Fuliza, and so perhaps that's where that would be a more accurate barometer of the impact of the job losses on repayment of loans rather than the formal banking sector.
Yes. Well, Josh, let's look at that data that were given by the Labor Department. It's unfortunate that we only have it up to quarter 3 of 2020, because if you look at those unemployment numbers, and before even looking at where we are in the banking sector, in the banking industry, the key performance indicators, which were quite resilient as well for the entire of 2020, you will see that we lost 1.72 million jobs all the way up to quarter 3 of 2020. You like to think, Josh, that it would improve that number, 1.9. Are we saying that, well, banks ran away from the private sector?
I'm not saying that they ran away from them because of COVID.
Yes.
I'm saying that perhaps there had been a migration before COVID.
Before COVID, yes.
So perhaps banks were not lending as much in terms of personal loans to people, for example, who work for an SME or people who work. Remember, again, a lot of this, who you'd call riskier clients, tend to then borrow from SACCOs and microfinance institutions. So I think, because banks have had this comfort, I think since the Jubilee government came into power, because banks have had this comfort of where they're able to lend at a much higher rate than before to government. So, I mean, if I'm a bank and I'm making a decision on who to lend to, I'll always lend to a client where my money is guaranteed a return.
Yes.
So the government loans are 100% secure. Number two, where the transaction costs will be as little as possible. So if I'm a bank, instead of lending to 100,000 people,
Yes.
10,000 shillings a person, I'd rather lend that money to the government. So I think it is more a pointer of the nature of clients that banks were lending to, and the focus on people who work for TSC, people who work for the National Police Service, people who work for the civil service, because such clients are more secure in terms of the strength of their pay slip, number one. Number two, it's very difficult for them to be declared redundant, because public service jobs are normally lost as a last resort. And we might see the loss of public service jobs, particularly in this financial year,
yes.
especially with the IMF loan facility that we took on. But I think so far, I am willing to bet that a majority of the clientele, even though my data is very anecdotal, a majority of their clientele and a majority of the people who are paying those loans back are people who are working in the public sector.
Pretty much. It's a good thing that you've actually touched on my last one, because my last one was going to be what would be the outlook of this segment in 2021 amidst the increased caps to prevent the spread of the COVID-19 pandemic. Josh, do you expect that the banks are going to still have that same positive sentiment to the corporate sector in 2021?
I don't think so. I think we're going to see people who are out of a job, say people who lost their jobs in October.
Yes.
I think things are beginning to crystallize now. So the longer they're out of jobs, the worse it's going to be. We saw a bit of recovery around towards the end of last year, but that's because the restrictions have been lifted.
Yes.
Now we have restrictions back. So I think these numbers are bound to change, particularly when it comes to personal loans. And we're bound to see now an actual negative downturn and an actual impact towards the end of the year, especially because we might see losses or job cuts in the public sector.
Pretty much. On to the next one. A Central Bank of Kenya CBK report now indicates that a high number of company chief executives in Kenya believe that the high cost of doing business and taxation, as opposed to the disruption of the COVID-19 pandemic, pose the biggest threat to their operations over the next 12 months. Now, the survey indicated that while majority of business executives consider a substantial economic rebound in the second quarter of the current fiscal year on improving orders and sales, Kenya is still navigating a tough business environment that poses a threat to the expected rebound. Now, the executives indicated in the report that withholding tax, VAT refunds and excise duty on a fast-moving consumer goods and the introduction of the new taxes under the Finance Act of 2020 stand as the biggest challenge to business growth in 2021. Now, the state saw the charges imposed on mobile phone-based transfers of small amounts of cash at the end of last year reintroduced this year, having had them removed in March 2020 to encourage cashless transactions and curb the spread of the virus. 2021 also saw the state revert to all the tax measures they introduced in 2020 to cushion the economy from the pandemic on the back of dropped collections and the rising need for revenue to run state projects. That's where we are. Let's look at that tax performance data and 2020 so that we can actually have a talking point. And you could see that VAT was among those ones that really performed decimally last year. Domestic excise as well. We also have fuel and oil taxes in the country as well that are also dropped. Now, that's where they're coming from. That since we are back to that state, it's not COVID, it's the cost of doing business. Josh, do you agree with the company executives who are in that CBK survey?
I tend to agree, yes.
Yes.
And in agreeing, I'm going to make reference to a report by Stanbic, which was done in, I think, 2018,
yes.
the Purchasing Managers Index. And the Purchasing Managers Index from Stanbic indicated that even at 2018, you had an exodus of manufacturing companies in Kenya, and they were moving to better alternatives in the region. I mean, we're talking Ethiopia, we're talking the rest of the East Africa Community region. And the main reason they gave for their exit was unplanned taxation and an uncertain business environment.
Yes.
Now, so why I tend to agree with the executives is COVID is a year old now. But we have an impact of unplanned taxation and excessive taxation, if you ask me, that has been building up over a period of, say, about 5 years.
Yes.
So we've got a very tricky debt situation as a country, and that has forced governments to continually increase taxes, particularly in manufacturing and other sectors. And I think that now is squeezing, but in terms of increasing the cost of production. And I think the cost of doing business now, because we're looking at a situation where we are at a cost disadvantage of 13% compared to our neighbors. So compared to Uganda, compared to Tanzania, compared to Rwanda, our cost of doing business is 13% more. And so that paints a pretty grim picture. And we are comparing this with what we say is economic growth. But again, many reports have found that the economic growth that we're talking about is superficial because it's not generating jobs and it's not growing the economy per se. So it's when government does one large infrastructure project, it's captured as GDP growth, but it's not necessarily growth on the ground. It's not necessarily jobs being created. And so I think, yes, I agree when people say, when the executives say that the cost of production is a bigger threat than COVID, it really is. Because again, COVID is a short-term thing.
Yes.
I mean, we expect that we'll be able to deal with it sooner or later. But cost of doing business is a more permanent challenge when it comes to if you're a business executive, it's a more permanent challenge to overcome.
Yes. Is it a done deal, especially when we're talking about the cost of doing business in the country? And I want to ask you in this sense, if taxes are the bigger threat to businesses in the country than the impact of the COVID-19 pandemic, is 2021 going to be a rebound year, Josh, as people are saying? Because if the company executives are saying, well, it's not even about COVID, it's about the cost of doing business within the COVID-19 pandemic. So is 2021 going to be a rebound year, as most people will say? I mean, Josh, we do have the IMF telling us that this year we expect to grow our economy by 7%. Is it going to be a rebound year?
I think it's I wouldn't call it a rebound year, but it would be a year of growth compared to last year.
Yes.
Because now we've got the vaccine in place. We've got a bit more certainty about as Anthony was saying earlier when they were still on, he said, at least now we know what this COVID animal is and we know how to deal with it. So the uncertainty surrounding the value chain last year is not as persistent. We will not be as persistent this year. I think once we deal with this third wave and the restrictions are attendant to it, then definitely we are going to see growth. Whether we are going to rebound to pre-COVID levels, I'm not too sure. But we're definitely going to see growth if we are using 2020 as a base year.
So is it possible for the government to actually actively bring the cost of doing business in the country down, Josh? Or if you look at exactly the way our taxes performed last year, is that we are tied to that high cost of doing business?
I think, and we have seen a few steps in the right direction by government.
Yes.
For example, I remember in the Finance Bill 2020 where we had steps to try and reduce the cost of landing raw materials into the country. So, for example, the railway levy was reduced to 1.5%, and there was a few other raft of measures that were included. I think it was 2019, the Finance Bill of 2019. The problem I find is with government policy, and as a policy analysis, this is something that I've interacted with quite intimately.
Yes.
There's a disconnect between the policy and the implementing agencies of that policy. So I mean, the headline might be that the railway levy has been reduced, and therefore you'd expect that landing of goods to Nairobi would be cheaper. But then the agencies tasked with implementing that reduction, there isn't really synergy between them. There isn't synergy between the policymakers, the agencies, and within the agencies themselves.
Yes.
So I think the only thing, I don't think government has much leeway to do much more in terms of reducing cost of revenue because, again, of the debt situation. But what government can do is try and increase synergy within implementing agencies of government for policies that have already been put in place and measures to reduce the cost of doing business.
Pretty much, Josh. I want to say thank you very much for joining us this morning to open our book,
You're welcome,
business-wise. All right, that's exactly what we have for you. Remember, you can be a part of the conversation even after we log off screen at Metropole TVKE across your social media platforms. Talk to us 20146. I am at Kia Simba. I will see you at 10 and 11 for Metropole News. Good morning.